Hello, I'm Hickey from interest.co.nz and welcome to another in our series of double shot interviews. This is where we bring in a chief executive or a minister or someone who's got something interesting to say about the things that we care about here at interest.co, and currencies are certainly at the top of the agenda at the moment. They're moving all over the place. There's so much happening internationally and at home that's moving the New Zealand dollar and lots of other currencies. And so we thought we'd bring Daniel Bell in, who's a senior dealer at HiFX, to give us an idea of what's happening with currencies every week or so, just to understand what's been going on in the last week and what's happening in the next week or two to come. Daniel, thank you very much for coming into interest.co.nz. The New Zealand dollar, it's up near 80 US cents. It's amazing, really. What's driving it up there?
Yeah, it is, and you know, a lot of people are surprised, but at the same time, I think if you're looking at the global economy and looking at what's happening with the US dollar, I think it's probably justified. You know, yesterday we saw a little bit of a sell-off, but today we're back up around 80 cents. In fact, the interbank market has traded just a shade over 80 cents today. So Kiwi has been very, very strong on the back of broad US dollar weakness again, and it's followed the Australian dollar higher, which has made another new post-float high this afternoon, just over 107.40. So
that's astonishing, isn't it?
Yeah.
Why are people so keen on the Australian and New Zealand dollars?
Well, I mean, it's all about yield, and you know, you've got the US dollar with interest rates still essentially at 0 to 0.25%. You've got their central bank committed to an accommodative policy stance, so effectively loose monetary policy. And in the background, you know, we've had an upbeat corporate earnings week out of the United States. So, for example, this morning the Dow Jones was up over 1.5%, which is a very strong rally. And in fact, the Dow Jones is now the highest at the highest level since June 2008. So we're sitting at almost a 3-year high for the bellwether equity index in the United States, and that's been pushed up by, as I said, stronger corporate earnings in the United States. And
when people feel good about those markets, they tend to look for riskier assets to buy, including Australian and New Zealand dollars.
Yeah, correct. Yeah, so the Aussie dollar and the Kiwi on a relative basis are still very attractive to offshore investors. We know in our own economy that we've got issues, but if you compare us to Europe, to Japan, to the United States, and to a lot of other economies, we're not in such a bad place. And even though our RBNZ cut interest rates in March down to 2.5%, our interest rate in comparison to a lot of other developed economies is still quite attractive. So, compared to the United States, where effectively rates are 0, Japan, where effectively rates are 0, even Europe, where rates are only 1.25%, and also the UK, where rates are sitting at, their benchmark rate is sitting at 0.5%. So it's all, currencies are a relative game, and at this time investors are feeling quite happy holding New Zealand dollars.
So on that interest rate front and the Reserve Bank, this coming Thursday, the Reserve Bank will most expect hold that official cash rate at 2.5%, but what else will people be looking for?
Yeah, so the market is expecting the RBNZ to leave the OCR at 2.5%. Obviously, they recently cut the OCR by 50 basis points in response to the Christchurch earthquake. And I think at this time they're going to want to see that stimulus continue to provide support for the local economy. Recently Bollard was out last week, in fact, stating that our terms of trade, which is very, very strong at the moment, i.e., our commodity prices are at historical highs, and he also said that the currency, or the New Zealand dollar against the US, was reflective of that. So at this time, I think he's going to keep interest rates on hold. It'll be interesting to see what his statement has to say, and obviously, where interest rates go from there.
And what are markets pricing in for the official cash rate over the next few months and into next year?
So most economists are seeing rates on hold for the next few months, but the market is starting to price in a rate hike as early as December this year. So it'll be interesting to see what he does, whether it's September, December, or early next year. And there's obviously going to be quite a bit of interest around the statement next week. but also how the economic data unfolds over the coming months.
So just a statement next week from the Reserve Bank, but every 3 months they have a press conference and a full monetary policy statement. This next week, the US Federal Reserve, the notoriously secretive US Federal Reserve, which normally, if you're lucky, you get a statement out of an FOMC meeting, but next week, Ben Bernanke, the chairman, is going to come out after the FOMC meeting and have a full-on press conference. What do you think people will be looking for from that?
That's right. It's pretty eagerly awaited. The FOMC made a statement a couple of months ago that they were going to provide a media press conference every quarter. So not on every FOMC announcement, but every quarter, to provide enhanced transparency to the markets.
Taking their guidance from the Reserve Bank of New Zealand, I think.
Well, yeah. I mean, I think our Reserve Bank is held in quite high esteem by a lot of the offshore central banks, and I think at this point in time, markets need more transparency. There's a lot of second guessing going on, particularly around the Federal Reserve, where you've got various members of the Federal Reserve making contradictory statements to the media. So some are a little bit more hawkish than others. Some are more dovish than others. So the market is sort of second guessing what the US Federal Reserve are up to, and I think part of this press conference is going to give Ben Bernanke, the chairman, an opportunity to for a bit of Q&A and set the market straight.
So at the moment, the US Federal Reserve is finishing off its second round of quantitative easing. This is buying US Treasury bonds, $600 billion in this current program, due to end at the end of June. What's the market saying about what will happen after that?
The whole issue around monetary policy in the US is really crucial. A lot of the market is sort of blaming the Federal Reserve for the huge run up in commodity prices and the flow-on effect that that's having from an inflationary point of view, and also the impact that that's having on asset prices around the world. But on the other hand, US policymakers are committed to getting their economy back on track, and they're quite focused domestically, and they're at a point where they're prepared, I think, to do whatever they need to do to get their economy on track. And as far as inflation is concerned, I think that's a secondary issue for them. So, yeah. So
QE3 light?
Listen, some people again are starting to talk about QE3 in some kind of form. Obviously, they have the mechanisms available to provide further stimulus. I think it's going to be interesting to see how the fiscal side in the US also plays out. Obviously, Standard & Poor's downgraded the outlook for the US this week, which, whilst not a surprise to a lot of people in terms of understanding the debt position for the US, was a surprise that they actually did it. And in fact, saying something to the market. So perhaps if the US government undertake fiscal austerity measures, perhaps the US central bank may step in to provide further stimulus down the track. So it's
interesting times ahead with the US government, with this debt ceiling due to expire in the next couple of months. Do you think the political ructions around Congress and the budget and the debt ceiling could have an impact on currency markets?
Oh, without a doubt. The current situation in the US as far as their fiscal position, the tension between the Republicans and the Democrats, and the fact that they can't really get their act together, is causing a lot of uncertainty. And you're seeing that reflected in the price of gold, for example, which is trading over 1,500 US an ounce. So that the price of gold is being used as a sort of hedge, if you like, against the US dollar. And markets want to see a little bit more certainty around the fiscal position in the States, and at this stage there's still a lot of uncertainty.
Now, going across the ditch, the Atlantic, at least to Europe, been quite a bit of action in the last week around that sovereign debt situation. Talk that Greece might have to be restructured. We've seen the Finnish revolt over the bailout. The Irish have just dug into their banks and found another black hole. And of course the Portuguese are in the process of negotiating a bailout. What's happening around confidence in the euro and on those European sovereign debt markets?
Yeah, well, as we all know, there's still huge sovereign debt risk in the euro region. But I think to a certain extent, that the market seems comfortable with some of the potential risks out there. Take the Greek situation, for example, which has been in the headlines again this week. Rumours that they may need to restructure their debt. I think most economists in Europe are expecting that the Greeks will need to restructure their debt. It's $330 odd billion worth of sovereign debt there. So in a way, I think the market's already priced that in. As far as the situation in Ireland and Portugal, again, there's political issues going on there, and Finland, as you mentioned too earlier this week, there's a little bit of political pushback there around what the euro is actually, what the ECB are doing, and what the euro region is doing for some of these these countries that are in a pretty negative debt position.
And how's the euro looking versus the US dollar and let's say the New Zealand dollar?
Well, the euro's been very strong again. I mean, we had a bit of a drop earlier this week. The euro had pushed up earlier this week to a 15-month high of around 1.45, and then came off back towards 1.40, 1.50. But today we've actually pushed up over 1.45, trading around 1.458 also this afternoon. And that reflects, I think, again, US dollar weakness more than anything. And the ECB, who are obviously controlling interest rates in the euro, have already raised rates recently, and they've indicated that they're going to be prepared to raise them further. So the euro is being rewarded by investors because their central bank is prepared to raise interest rates and obviously curb inflationary pressures. So quite different to the situation in the US.
And so how does that reflected in the New Zealand dollar euro cross rate?
Well, the Kiwi against the euro cross rate, for example, I mean, we saw it come off pretty quickly after the earthquake, and then following the Japanese earthquake and the tsunami, there was a lot of risk aversion, a lot of unwinding and sort of carry trade positions, and typically the New Zealand dollar falls under pressure against most of the major currencies in that event. But last week, the New Zealand dollar was one of the top performing currencies. So I think investors and traders have sort of moved through that risk, and the Kiwis pushed back up over 55. But earlier this week we had a lower inflationary reading, which saw the New Zealand dollar under a bit of pressure. So fairly muted against the euro, to be fair. We are keeping pace with the euro against with the euro against the US dollar. So if you look at the euro trading around 145, and some people are calling it up to sort of 150, that would be another sort of 2%. If you look at the Kiwi trading at 80, another 2% would see us trading around the all-time post-float high, which is around 82 cents. And on the other hand, you've got the Aussie dollar sitting around 107.40 at the moment. You've got some people calling that up to 110, which again is another sort of 2.5%.
Could be a tourism operator or an exporter in Australia. That must be, or manufacturing exporter at least.
Absolutely. It's Australia is the Australian dollar again is one of the most favoured currencies in the world, and their economic performance continues to be very strong, but clearly there's some risks out there.
No wonder all these Australians are going onto online purchasing sites and buying stuff.
Absolutely.
Now, just finally, right around the world to China, such an important part of the world now for New Zealand and Australia. And in the last week or so, we've seen China tighten its reserve requirements for lending, relatively strong GDP and inflation numbers. People are watching to see whether they tap on the brakes too hard. Any idea on how that's going to play out over the next couple of weeks, things we should watch for out of China?
Yeah, I mean, I think, we're going to see further monetary tightening from China. I think that's a given. I think the tightening that we've already seen in terms of them raising the reserve requirements for their banks and actually raising their benchmark rate, I think we're going to see further follow through in that for the rest of the year. I think the Chinese policymakers want to be taken seriously by global financial markets, and part of that is saying, listen, we're going to be looking at price stability as a key issue in our economy, and people are talking about the Chinese property market and the huge risks associated with that market, and I think Chinese policymakers want to be serious about containing those risks. So it'll be interesting to see how it all plays out. Ultimately there's still some pretty huge circuit breakers out there. And hopefully, we don't see those circuit breakers, but there's still certainly plenty of risks.
Fantastic. There we are, right around the world in about 10 minutes. The world of currencies, markets, economies, the stuff we love to talk about here at interest.co.nz. Daniel Bell there, the senior dealer at HiFX. In another one of our double shot interviews, we'll be back again this time next week. A review and an outlook on currencies I'm Bernard Hickey for interest.co.nz.